We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. I'm Gabe Johansson, back in the studio, the SMI studio, with Mike Nuss, Dane McKinney, Trevor Howard, and the most famous special guest we've ever had on Deal Junkies, Jay Scott. Jay, thanks for being on the show today.
I'm sorry I'm not there with you guys. I'm hoping that by the time this comes out, you've kind of used AI to edit me into the table. So it's like we're all sitting together.
Well, I'm going to let Mike introduce you because he knows more. But if you don't know Jay, follow him on Facebook or wherever you follow. He's a wealth of information. So, Mike, why don't you go ahead and take over?
I thought he doesn't need an introduction.
Well, yeah, he does. He probably doesn't to most. Yeah.
All right. For those that don't know Jay, if you listen to this podcast, you should know Jay. And if you don't, then follow him. But my take on Jay is he's a tech exec, came from the tech world, got into real estate.
My take on Jay?
My take on Jay. Well, let me really start
Hot take.
Give me your opinion.
I didn't form an opinion on Jay until COVID when I got to meet you and realize that you rock flip-flops almost as well as I do. And so now you kind of became a fanboy over the past 6 years. So one of the original real estate content creators, a lot of big best-selling books for bigger pockets, came out of the tech world, got into real estate, specifically the single-family world, flipping hundreds of single-family homes. So ChatGPT actually told me some statistics about you.
I'm sure they're all true.
When we say tech, it was Microsoft and eBay. So I imagine you got some leadership skills, learned about capital stacks, capital markets, and we'll get a lot into economics. I imagine that drove a lot of your background. But then specifically bringing that to not just capital raising for real estate, but operations. So flipping over 400 homes, having a $60 million in transactions, hundreds of rentals, became the content creator like I mentioned. But then you met some friends of mine, Ashley and Kyle Wilson, got into the syndication world, eventually started the Drunk Real Estate Podcast, which is on hiatus. But what I've seen evolve over the past few years of you just really have dove into educating the nation when it comes to economics. Meaning you have such a strong economic background, not just from books, but from operations, and you bring a mechanical view on economics and the economy as a whole, which is what I appreciate. That's how I see economics. That's when I kind of became a fanboy and started following you. So really excited to break into economics. Today, you actually had a great post about the Fed meeting minutes came out, and this is the last meeting minutes for Jerome Powell, getting into Kevin Warsh. You bought and then broke ground on a large multifamily ground up construction project in Texas. One of the first projects you've done in a while, if I recall correctly. And going full circle, when I first met you in Boise, if I recall, that was when you and Ashley and Kyle really started looking into this asset class, multifamily apartments. The cap rates are so low, we cannot create value. So we're starting to look at ground up construction, which was 6 years ago, which seems like 2 cycles ago. It's really one full complete cycle. And then now you're really able to break ground on new construction at what I would probably say is the perfect time in a timing of cycle and economics construction boom. So there's your introduction. I don't think you needed one, but we wanted to give one.
Did he miss anything, Jay?
I think you hit the high points.
Okay.
All right. Cool.
Well, don't you own a horse racing team too?
I do own a bunch of race horses as well. I have some partners and we own some race horses.
I think that's important to note.
That is important.
So what do you do on Derby Day? I mean, that was just a couple weekends ago.
Yeah.
What did you do on Kentucky Derby Day?
I was actually traveling. Normally, I don't normally go to the Derby, but I grew up like literally walking distance to Pimlico racetrack, which is in Baltimore near it's where the Preakness takes place. And so we have an owner's box up in Pimlico. And so always go up there for the Preakness. The Derby, though, I don't generally make.
Oh, okay.
I love that because I know nothing about horses, but I loved Preakness growing up. Just the name is like way cooler than the Derby.
I just want to go to the Kentucky Derby one time so that I can dress up like I'm from the 1950s.
Wear a seersucker suit.
That's all that I mean, I want to see horses run too,
Foam
probably. Just very little people ride horses. But I think I had a career as a jockey.
You
somewhere.
probably could have been a jockey.
I think I could have. Yeah. But anyways,
So why tech? Why did you go into the tech world? What is your actual training and background quickly before we get into real estate?
Why did I go into tech? Honestly, and this is really dumb, but graduated high school and I need to pick a major. And I said to my best friend at the time, "What do you think the hardest major is?" And he said physics. So I became a physics major. Spent the first year in college as a physics major. Realized I wasn't that smart. So I asked around and asked what the second hardest major was. And I was told electrical engineering. So I ended up doing that, and that I was barely smart enough to do, and went from there to software development after college, and just kind of bounced around at a bunch of big tech companies.
Where are you from originally?
Originally from Maryland, grew up in Baltimore.
Oh, okay.
Then lived in California, went to University of Maryland, lived in California for a long time, lived in Atlanta, back to Baltimore, now in Florida. So kind of all over.
Which one's the best?
I mean, scenery wise, Florida.
Really?
But I was a huge fan of California, not the politics. I mean,
Mhm.
the politics weren't horrible, but little too extreme for me. In the San Francisco Bay Area.
Yeah.
But loved the people and loved the vibe out there as a tech guy. It's the best
Mhm.
place in the world.
So were you moving all around for jobs that you had in tech, or what was?
No. I did tech in California, and then when I met my wife, we left the tech world together. She was in tech also, and she can't stay put for more than 5 years, so she just moves us around every 5 years or so.
A smart man follows.
Fair enough. And so then what's been driving your career like past tech, I guess? What gets you excited?
I like challenges. I
Yeah.
like doing new things. I'm one of those people that I have shiny object syndrome, but I really try to harness it because I recognize that if I let it control me, I'd never get anything done. So my attitude is do something, spend several years getting really good at it, figure out how to understand it, make money off of it, automate it to some degree before I move on to something else. But honestly, the minute I move on to something else, I'm thinking about what the next thing and the next thing and the next thing is. And so, I'd say I shiny object syndrome, but I've figured out how to harness it.
So did you go to flipping houses from tech? Like, was
Yeah.
that your next step?
Yeah, it was actually it just kind of happened. My wife and I, we left tech. We decided to get married in 2008. Moved across the country from San Francisco to Atlanta. Atlanta was probably one of the hardest hit areas in the country back in 2008 for single family real estate. And we didn't know what we were going to do. Like, we didn't quit thinking we were going to go into real estate. We quit thinking, let's take the summer off, let's get married, and then we'll start a business or something, or we'll buy a business, or we honestly had no idea. And so that summer, one morning, it was like 130 degrees in Atlanta, like it is in the summer. And we're sitting in our basement watching TV, and a flip TV show comes on. And my wife says, we should flip a house. And I thought she was joking. I'm an electrical engineer who can barely change a light bulb. So I really didn't want to flip a house, but she was serious. She's got the design skills, excuse me. She's got the design skills, and I mean, can make things look pretty. So I said, okay, let's figure it out. And we flipped a house, and then we flipped a second and a third and a fifth and a 10th and a 50th. And at some point we're like, I guess this is what we're doing now.
I would assume that happened a little bit before 50.
Honestly, it's crazy because I think we did 50. It probably took us 2 or 3 years to hit 50. And I think during most of that time, we were still trying to figure out what it was we wanted to do when we grew up. And so it was a few years before we realized, okay, I guess we're all in on this real estate thing.
Wow.
So those were going successful for you just from the beginning, or were there hard times flipping those?
I always say I'm glad we bought the first 2 on the same day. We were working with the wholesaler. We didn't even know what a wholesaler was, who was trying to sell us some really bad deals, though we didn't know it at the time. And he brought us 2 deals that we finally said, okay, let's pull the trigger on one of these. My wife thought we should pull the trigger on one. I thought we should pull the trigger on the other. I said, okay, let's just buy both of them and see what happens. So we bought both, and luckily we bought both, because if we had bought the one that I wanted to buy, it didn't go that well, and we probably never would have done another one. But we ended up buying the second one, the one my wife wanted to buy. That one went great, which led us to doing the third and the fourth and the fifth. And so definitely that first one that I wanted was tough. It took longer to renovate than we expected. Lots of surprises in the renovation. Cost more than we expected. It took longer to sell. In fact, it took 3 years to sell it. We ended up lease optioning it, and we had a family in there for a few years. One morning, like, the rent check doesn't show up, and they're not answering the phone. So I go knock on the door. They're not there. Walk around the back. The door is broken in. They had left in the middle of the night because they couldn't pay rent. Who knows how long the house had been sitting, but somebody broke in and like just destroyed the house. So we had to do another renovation, and it was horrible. And honestly, again, if it was the first house we had done, if we didn't do another one at the same time, that would have been like it for me. I would have been, nah, I'm done with this.
So were you thinking you wanted to own rentals at this time too while you're doing this, or just trying to make money doing these flips?
Yeah. So we didn't know. My wife said flip a house. So we started by saying we're going to flip a house. And again, I didn't have much knowledge in real estate, or I knew a little bit about investing, but it was more equities type investing and big venture capital, M&A type stuff. I didn't know anything about real estate or what kind of like regular investments that most people do. So I had no idea. And it was probably a decade later that I looked back and I thought, wow, I really should not have been flipping all those houses. I should have held every single one of them, or at least as many as I could have, because, and it's the same advice I give to my kids these days, like buying and selling. You're going to pay taxes, number one, the transaction costs, number two, and you're not going to get the benefit of the there's long-term benefits in real estate that you're not going to get. And so in retrospect, it's like, I joke that there are like 500 mistakes I've made in real estate. And it was each of the 500 houses I flipped.
Man. So how big was the operation at peak for the flipping company?
It was never that big. And I think that's why I was so burned out by 2017. I mean, we weren't doing, you see a lot of people these days flipping 100, 200, 300 houses a year. We were doing 20, 30, 50 houses a year, which at the time, nobody else was doing that. So it seemed like a lot. But it was basically my wife, myself, we had a full-time project manager, and we had a couple other part-time people that were helping us. The nice thing was, we were in a part of Atlanta that basically grew in the late 90s, or I guess early 90s, 92 to 96. And so hundreds, thousands of houses were built in this one small area of Atlanta in the early 90s. And so that's where we ended up moving. And in 2008, all of those houses were like 16, 17, 18 years old. But they'd all been built at the same time. So we were putting offers on these houses, and every house we went into looked the same. It was a 3-bedroom, 2-bath, built by the same builder. Every one of them, because they were the exact same age, had the same issues. They all needed a new roof. They all needed new HVAC. They all had this thing called polybutylene plumbing, which was this bad plumbing product they used in the 90s. So all the plumbing needed to be replaced, needed full cosmetic renovations, but structurally they were all good. And so we'd go into a house and we'd do a scope of work. We'd go into the next house, exact same scope of work. We go into the next house, exact same scope of work. So we had a couple construction crews that literally would just go house to house. They do the exact same renovation. We figured out how to systematize everything and put good processes in place. So we'd be buying, like when we buy cabinets, we'd go out and buy 20 houses worth of cabinets. When it was Memorial Day, we would go to Home Depot and buy 20 or 30 sets of appliances on sale for the holiday. We'd call a roofer and we'd negotiate pricing on 10 roofs because we knew every house was going to be the same. And so we're really lucky that early on, basically we did the same thing on every house, which allowed us to scale pretty quickly. It allowed our contractors to scale because they didn't have to do special scopes of work on every house. They just do the same thing on every house, same materials, same layout, same cost. We would just write the same check every house.
Mm-hmm.
So what led you to getting connected with Bigger Pockets and writing all those books? Because when I was getting started, I read your book on estimating rehabs, and then I'm pretty sure you wrote some others as well, and I probably read those. But how'd you get into that?
Yeah. So I was looking to learn how to flip houses in 2008. And I went online and I said, how do you flip houses? And it took me to Bigger Pockets. And I started in Bigger Pockets just learning like everybody else that goes there. And I probably found it 6 or 8 months before I flipped that first house. And I was just asking questions just like everybody else, getting answers. And then after I flipped that first one, I said, okay, well, I can probably answer some questions now. So I was asking questions and answering questions. And then after that second one, I answered more. And after the third, I was answering more. And by 2009 or 10, I think I had more posts on there than anybody, even though it was a relatively small site at the time. The owner of the site, a guy named Josh Dorkin, he and I became friends. And he was a one-man show at the time. Like literally he started in 2004 and he had no employees until 2013. So 2009, 10, 11, we became good friends. I was kind of helping him out with just making some technical decisions on the site. I was helping him out with some business stuff. And we stayed friends. I remember 2013 when he hired Brandon Turner. He came to me and he's like, I just interviewed this guy who would be my first employee. Don't know if I want to hire him. He wants equity in the company. I can't give away equity in the company. And almost didn't hire Brandon. I talked him into hiring Brandon. And
good call.
Yeah, well, who would have known? And Bigger Pockets took off. And 2013, I decided to write a book. And I didn't know anything about writing or publishing books. So I went to Josh and I said, hey, I'm writing this book. Can I market it on the site? He's like, sure, if you want, we can like co-brand it and market it together and split the revenue. And I was like, great, let's do that. And so 2013 released 2 books in conjunction with Bigger Pockets. And that ended up being turning into Bigger Pockets Publishing.
What was the other one you did outside of the rehab costs?
Flipping houses. So the book on flipping houses and the book on estimating rehab costs were the first 2. Then in 2016 or 17, my wife and I wrote the book on negotiating real estate. 2019 or 18, I think, recession-proof real estate. And then a couple years ago, real estate by the numbers.
Right on.
So backtracking real quick, we have to thank Carol Scott for getting Jay Scott into real estate. More importantly, for picking the right house so they stayed in real estate.
Absolutely.
And then Jay Scott for making sure Josh Dorkin hired Brandon Turner. Without those things, without Carol, life would not be the same in real estate at all. It'd be a completely different world.
It could be. That's a really good point. My wife has basically changed the face of real estate single-handedly. I'll make sure
absolutely.
She knows that.
She's like the what's the opposite of godwoman, godmother of
Is
real
she
estate?
with you now, Jay? Can she come on the show?
I'm guessing she hasn't showered yet, but she'd make a better guess than I would.
Maybe next episode.
Get the godmother of real estate on here. That's amazing.
There you go. Yep.
Recession-proof real estate investing. You wrote that in 20. When was that?
It was 2018, maybe.
Would you change anything that you wrote then, living through what we've lived through now?
Oh my God. I've already done one formal revision of that book. I could probably rewrite that book now. Although I don't know what I would say. Like it feels like economics in this country was pretty stable and status quo and consistent for 200 years. And then the last 5 years, things have kind of gotten crazy. So yeah, I stand behind everything I wrote in that book, but I could probably write a whole second book of just everything that's happened in the last 5 years.
I'm curious how you'd rate these 4 events. 1913, 2020, 1971, and then the 1980s evolution of the private bond markets as far as historic events in the chain of our economic history.
So 1913, I think, was at the time, I assume you're referring to the creation of the Fed.
Yep.
It was pretty much a non-event at the time. I think you have to look forward 50 or 60 or 80 years before that becomes a real event in our country. Let's take them individually. I think that had to happen. I don't think U.S. dollar becomes the world's reserve currency in the mid 40s if we didn't have a Fed that was essentially controlling global economic policy. So one of the reasons why the U.S. dollar was chosen, the U.S. had the strongest military in the world, and people don't realize it, but military might and economic might go hand in hand.
Mm-hmm.
You're not going to be the strongest economic country in the world. You're not going to own the world's reserve currency if you can't forcibly defend it. And it's one of the reasons why we maintain the reserve currency, because we can militarily defend it. But the other reason is we were basically the adults in the room. We were the ones that had been driving economic policy for the last 20, 30, 40 years since the creation of the Fed, even before the creation of the Fed, which gave us credibility. So the creation of the Fed in 1913 is one of the things that led to the fact that we got the world's reserve currency in the mid 40s, and has led to us being the most prosperous country in the history of the world over the last 60, 70, 80 years. So to some degree, I could say that's probably the single most important event economically that's happened in this country that's gotten us to where we are today. But again, it wasn't as meaningful at the time.
Yeah, real quick before you go on to the next one, the way I look at it is you could look at America up until 1907, 1913 as just an emerging market for the world. And then the creation of the Fed in 1930 is what stabilized it and led the way from changing it from an emerging market to the world economy, the dominating economy in the world.
I mean, think about it. You have countries like China, countries in Europe that have been around for hundreds, thousands of years before the U.S. was even like a concept. And the fact that we were able to, within just 120 years or so, build the largest economy on the planet, we did something right. And I think the creation of the Fed, and I know a lot of people hate the Fed, a lot of people think the Fed should be abolished. For the most part, I think the Fed has constrained us in ways that it probably shouldn't. I'm not going to argue that the Fed, everything they do is great, and we shouldn't be pushing back on some of their charter and tactics. But at the same time, I'm a big believer that the Fed is what's gotten us to where we are today.
When you say like some of the things that they've done, are you speaking more recently in terms of the Fed's, I guess, policies that they've enacted over the past few years, or is that just across the lifetime of the Fed?
Well, keep in mind, for the most part, the Fed has two charters. There's two things that the Fed was created to do. If you look at their charter, it's to manage employment. So basically, in simple terms, keep unemployment from going too high, keep people employed. And then number two, manage pricing, manage inflation, and make sure prices don't go too high. And that's really the two things they were created to do. Anything else they do over and above that is beyond their charter. And so when I say I think the Fed has been tremendously valuable, I think they've been tremendously valuable in accomplishing those two things that they were chartered to do. Now, you could argue that the free market without the Fed can do the same thing. You can even argue that it might do it better. And in some ways, it could do it better. The free market would probably operate better than the Fed controlling the injection of capital and pulling out capital from the markets, lowering interest rates. I mean, without the Fed, these things would happen anyway. Money would move into markets. Money would be taken out of markets privately. Interest rates would go up or down based on just the market controlling interest rates. But what the Fed does is they smooth the curves.
Yeah.
The Fed keeps things from going too far in any direction. And that's part of the reason why the U.S. is so economically powerful, is because we're stable. There's a stability. Why isn't the yuan, the Chinese currency, why couldn't it take over from the U.S. dollar easily? The biggest reason is it's not nearly as stable. You can say the same thing about most of the European currencies. They're not nearly as stable. It's the same reason why Bitcoin people who think Bitcoin should basically be the de facto reserve currency, it doesn't make any sense. Valuations for Bitcoin go up and down. Valuations for the yuan and the yen and all the European currencies basically go up and down willy-nilly, and there's not a lot of stability, not because they don't have central banks, but simply because our central bank tends to do a better job. And so I would argue that the Fed has been instrumental in creating a stability of our currency that has allowed us to maintain economic dominance over the last 100 years. Now, more recently, the Fed has done some things that are outside of their charter. The whole basically bailing out industries, bailing out the consumer, running up their balance sheet to basically inject liquidity into the market and take liquidity out of the market. You can argue that has kind of overstepped their charter. You could argue that that's not been in the best interest of this country economically. It's a reasonable argument, and it might be right. The problem is we look at 2008 and 2020. If the Fed didn't overstep their charter, if they didn't basically run up their balance sheet and inject a ridiculous amount of capital into the system, what would the results have been? Would they have been better than what we saw after 2008 and 2020? Would it have been worse? We don't know. And so it's a reasonable argument that the Fed has overstepped their charter and they've hurt things by doing so. But it's also a reasonable argument that, hey, we're still here and we're still economically dominant, even though we have our issues. So maybe they've done things for that were good. It's hard to know.
This is a great foundation to get into those other dates because their job has changed significantly. And what you're talking about is the border between the Fed monetary policy and politicians and political policy. And that's specifically why I brought up 1971 political decision and then the bond formation, the bond market formation in the 80s, because now that's the private markets taking over. And then specifically 2020, because that's when the Fed got so tied to the politicians and the ridiculous amount of printing. And even since then, the Fed's tried to decouple and the Fed's tried to reduce its balance sheet while the government just continues to spread. But now we're getting into a new era where the new president, Warsh, really has been adamant about saying reduced balance sheet. His historic comments are reducing the Fed's influence in the bond markets and creating a very big divide between political policy and monetary policy. But we have these periods of time like 1971 when we go off the gold standard. And it looks like now when you look how Trump and the current administration have talked about the past Fed and how they want to lower rates and how they want to put their person in there, it looks like on one side, from the media side, we're getting closer. Monetary policy and political policy are getting closer, but the next Fed president actually wants them to be further away. So I'd love to see your thoughts about how those events changed what the Fed does and then potentially like what you see them doing in the future.
Yeah. Okay, let's start with the gold standard. I'm going to be quick on this one because I probably have a contrarian opinion to a lot of people, but it's not my area of expertise. Number one, we were off the gold standard before 1971. So 1971, Nixon formalized it and basically repriced gold. But the reality is, you look at the Second World War. If we had only been able to print the amount of money that we could back by gold, we would have lost that war. Part of the reason why we were able to win the Second World War is because we printed so much money over and above what we likely could have justified based on our gold stock, that we were able to win that war. And we went into some significant debt in World War II at the time, relatively speaking, not compared to today. And so my best argument for being off the gold standard is sometimes you need to have access to capital that requires deficit spending. Sometimes you need access to capital that you can't collateralize. And without that, again, I think we wouldn't necessarily be the most dominant economic and military nation in the history of the world. So I'm not necessarily against going off the gold standard. Obviously, it has created significant problems. We've printed a ridiculous amount of money that we we have no backing for. I mean, you look at our currency, it's backed by the full faith and promise of the U.S. government. What does that mean? I mean, it's meant a lot for the last 100 and so years, but with 40 trillion in debt, it may mean a lot less now than it did. So, but anyway, long story short, I'm not against going off the gold standard. I am against the $40 trillion that we printed. I don't think those two are conflicting opinions. In terms of 2020 and the Fed kind of running up their balance sheet, they did that in 2008 after 2008 also. Not to the same extent, but we saw very similar activity. You could argue again that it was outside their charter. They shouldn't have done it. But by the same token, we got through 2020, 2021, 2022, all the way to 2026, and we haven't seen a technical recession. Now, we could argue that there's been a recession. It hasn't been declared. The data doesn't really make it look like. That's a whole separate discussion. But technically speaking, we haven't seen a recession. To get through 2020 and not see a technical recession means that somebody did something right. And I would argue that the Fed, again, going over and above their charter, they probably did too much. I'm not necessarily saying they did everything perfectly, but I think what they did, running up their balance sheet, injecting liquidity into markets, a little bit of propping up businesses too big to fail, was a good thing. And I think Powell did not do nearly a good enough job of running down the Fed's balance sheet. He did a pretty good job. I mean, he took it from it was like around 9 trillion and he got it down to like 7 trillion. I'm making up numbers. I don't remember the exact numbers, but he got it down a couple trillion. And I think Warsh will do a good job of continuing that trend. I think he'll be slow and steady. And I think if in the next 4 or 5 or 6 years, he can get the Fed balance sheet back to zero, it doesn't mean that our deficit's going to drop. It doesn't mean we're not going to be 42 or 43 or 45 trillion in debt at the time. But I think it'll be a good start for us economically getting back on the right track.
Well, one of your most recent posts, Jay, you talked about kind of the Warsh Fed and the Powell Fed, and I think you were talking about how Warsh or maybe I read this somewhere else, how Warsh wants to push you're saying how they're going outside the lines of their charter. He wants to push some of that back to the Treasury.
Yeah.
Can you explain that to me? I don't really understand how the mechanics of that work.
Yeah. So, and I'm not going to claim to be an expert here. He's made this statement and I haven't fully thought through the mechanics of it. I'm not sure anybody has except maybe him. But his thought is a lot of the things I'm talking about, basically buying assets, selling assets to inject or reduce liquidity in the markets. His argument is that's not something that the Fed should necessarily be doing. Keep in mind, the Fed doesn't print money. Everybody thinks the Fed prints money. The Treasury prints money. Mm-hmm. And they can do that at Congress's direction. To some extent, they can do that at the Fed's direction. But ultimately, it's the Treasury that controls the money supply in this country and that actually prints the money. And what he is saying is that the Fed makes too many decisions with respect to how much money is out there, how much liquidity is in the system or being taken out of the system, and that responsibility should be shared or even pushed back towards the Treasury, not necessarily the Fed. And the Fed should get back to doing their original charter, which is not controlling, but making sure that employment and inflation are under control, using their historically authorized power, which is interest rates, and to some degree, deciding how much liquidity to inject. But typically, historically, when they inject liquidity into markets, they do it on the very short term. They do it overnight. These things called repo and reverse repo actions. And so what we're seeing now is the whole long-term liquidity, buying bonds, buying other assets, mortgage-backed securities that sit on the balance sheet for years or decades. That's not something the Fed should be doing. And he's just saying, kick that back over to the Treasury.
Yeah, and the Fed's made it pretty clear that they don't believe they should be owning mortgage-backed securities. And if you think of it from the real estate market segment, is if you have so much investment capital from pension funds and insurance companies in the big macro world where they're going to allocate a certain portion of their capital stack to owning mortgage-backed securities, if the Fed comes in and buys a significant amount of those mortgage-backed securities, that just resets their capital so they can give more loans. And that's what we saw in the real estate aspect. Now, you mentioned that we did the printing in 2008. We did the printing again in 2020. And then you mentioned that Powell was able to reduce the balance sheet from around 9 trillion to around 7 trillion.
Yep.
And then the comments from Warsh are, we want to continue that process of reducing the balance sheet. But what I see it's different from 2020 to 2008 is there was never an ability to reduce the balance sheet. Once we started in 2008, there's essentially 3 or 4 levels of QE that existed, different levels of printing at different levels of time. And then we had the taper tantrum from like 2014 to 16 and 2017, where the balance sheet stayed level. Anytime the Fed tried to reduce the balance sheet, then we started seeing recessionary signals. So there's no ability to reduce the balance sheet at that point. Then COVID happened. Then we expanded more and we've been able to reduce. But where I really struggle with Warsh, especially as someone who trades real estate, I buy and hold it, but I also trade it. His comments really scare me, because if their thought process is continue to reduce the balance sheet, which then effectively reduces the money supply, and we're already in a transactional recession, real estate is now negative appreciation rates, inflation adjusted. Is there a floor that Warsh cannot go below on the balance sheet? That's kind of what keeps me up at night, is if there's no floor and they're just willing to reduce and reduce and reduce, and bond yields respectively go up and up and up, and then mortgage rates go up and up and up, that's what scares me at night. So part of me really wants a floor. Part of me really wants that floor to be like $6 trillion. Part of me wants them to start buying 10-year yields again. Part of me wants to have them lower the rates on the short end curve and then buy bonds on the longer end of the curve. Like, how do you unpack? It feels like we're really at a very huge transitional time. And to your post this morning, the Fed's more divided now than they ever have been historically. And it's right at the time of a Fed president or chairman change, with arguably some of the most political pressure on the Fed we've seen since I've been understanding these things. How do you unpack it?
So let me start with, I don't want to lose more listeners than we probably already have in this conversation.
I know our listeners love this.
So let me simplify things a little bit. When we talk about the Fed balance sheet, it basically, the Fed can control how much liquidity or capital is out in the markets they buy stuff up and put money out, or they sell stuff and pull money back in. And at the end of the day, when we talk about the Fed's balance sheet, it's basically the same as the Fed increasing or decreasing interest rates. So when they put money into the system, basically they buy assets, they buy bonds, they buy mortgage-backed securities, whatever assets. They take those assets, they hold on to them, and they pay for them with money that's printed by the Treasury. That money goes out into the system. So you have more money flowing out into the system. That is equivalent to dropping interest rates. When you drop interest rates, you generally get more money flowing through the system because people can borrow money cheaper. They can't get as much in savings accounts. And so when you think about like the Fed just flooding the market by buying assets and putting it on their balance sheet, that's the same as lowering interest rates, and vice versa. When they start selling things off of their balance sheet and pulling money out of the market, that's the same as tightening or raising interest rates. And so when we talk about the Fed kind of being able to do two things, they can raise and lower interest rates. They can also increase or decrease their balance sheet. It's basically two ways of doing the exact same thing. And so the Fed's job is to kind of figure out, one, do we want tighter monetary policy, which means essentially higher interest rates is the way we normally think about it, or looser monetary policy, lower interest rates? And then if we decide we want tighter monetary policy, there's two ways to do that. You can raise interest rates, or you can sell off assets from your balance sheet. You can basically pull money out of the system and make your balance sheet lower. Likewise, if you want to loosen monetary policy, lower rates, you can either literally lower rates, or you can buy more stuff, buy more assets, and flood the market with liquidity. And so the question of can the Fed reduce their balance sheet? They certainly can, but they may have to offset that with interest rates. So basically every $1 trillion that they add to their balance sheet is equivalent to essentially loosening monetary policy by about 0.25%, maybe 1/8%. And so if you think about it, if they've got right now, what is it? I brought it up while you were talking, something like 6.7 trillion on the balance sheet. That's probably somewhere around, if they sold everything on their balance sheet, took their balance sheet to zero, that's probably equivalent to tightening monetary policy by about 1.5%, raising interest rates by about 1.5%. So what would happen if we raise interest rates by 1.5%? Well, that's the same thing that would happen if they took their balance sheet to zero. And so the question is that a bad thing right now? Certainly 1.5% would probably hurt the economy. But there are a lot of people right now who think raising interest rates 1/4 or 1/2 or 3/4 of a point isn't necessarily a bad thing, given where inflation is, given where some inflationary pressure is that we haven't yet realized. And so I think there's still some runway for Warsh to sell off the balance sheet. Probably not the whole thing. But it's one of those, I know you said that a lot of the comments he's made have been concerning. One of the comments that he's made that I find actually very reassuring is that he wants to do his entire economic thesis. He wants to carry out slow and steady. He doesn't want to come in and make any big changes. And so he has said he wants to sell off the balance sheet, but he wants to do it over a long period of time. He's realistic in that he's not going to force changes that don't make sense. And he's getting a lot of political pressure. I have to imagine one of the reasons that Trump picked him was because he signaled to Trump, hey, you want lower interest rates? I'll try and get you lower interest rates. But at the same time, he's a smart guy who's been pretty hawkish on monetary policy historically. And so I don't think he's going to give in to political pressure. I don't think he's going to make any rash decisions. I think he's going to do slow and steady and be data driven. And I'll be honest, I thought Powell did a great job. So a lot of people think, oh, you like Powell, you're going to hate Warsh, and vice versa. No, I think Warsh is going to do a great job also.
Yeah, and let me qualify my comments. They concern me as a real estate owner, not as a citizen, a consumer, because I do agree with that aspect. Do you think typically the two tools that you mentioned, interest rates and buying bond or buying assets, they work in the same direction, meaning when they're buying, they're also lowering interest rates? Do you think it's a possibility that Warsh comes in here and reverses that, meaning they're selling, they're lowering their balance sheet, but to then offset that on the other side, they're actually lowering interest rates?
Yeah, sorry, and I think that's where I started to go when I started that conversation. That's part of the balancing act. They can use to pull those two levers in opposite directions to even each other out, in theory. Now, anybody that pays attention knows that the Fed doesn't really control mortgage rates. Here's a little quiz. How much has the Fed dropped their interest rate, the federal funds rate, over the last year and a half?
It's like 1.75.
1.75%. How much have mortgage rates come down in the last year and a half?
None.
They haven't. They've gone up.
Yeah,
they've gone up. And so it's a good reminder that the Fed, we like to think, yay, I mean, Trump says we want 1% interest rates from the Fed, and people are like, we want the Fed to lower interest rates so mortgage rates come down. But this is a good reminder that the Fed can do whatever they want, but it's the market that controls interest rates. It's investor sentiment, it's inflationary pressures. It's a lot of other things besides the Fed that control mortgage rates and car loan rates and business commercial loan rates and credit card rates and all these other rates that we care about. We don't care about the Fed's rate. The Fed can do whatever they want with their rate. If it doesn't translate to helping the rates that we care about, it doesn't matter. And for the last couple of years, whatever the Fed's done hasn't translated into helping the things we care about.
Well, it happens in two different ways. So like as a seller of real estate and an owner of real estate, keeping the interest rates high makes it really difficult to extract your liquidity. So selling off the bond sheet. So if he reversed those two things, he lowers interest rates, but then he's also selling off the 10-year yield, for example. We get upward pressure on mortgage rates, which then hurts the values of real estate, slows down transaction value, just reduces the speed of real estate. But on the flip side, if they're lowering interest rates on the short-term curve and then other consumer debt is going down, as a rental property owner, now my tenants are a little bit healthier. Now they can weather a little bit more storm to offset some of our costs through rent increases and whatnot. So I look at it as affecting us in two different ways. Is that a correct way to see it? Like, should we be excited as rental owners if the Fed rate goes down because consumers will be a little bit healthier?
Yes, but there's no free lunch. We can be happy about that, but what's the longer term consequence? We're likely to see more inflation. And more inflation basically means that those renters, while they're happy that the rates have come down, they're now seeing an erosion in their purchasing power because things are more expensive because lower rates drives inflation, drives demand, drives prices. And so, again, I think at this point, we're giving way too much credit to the Fed to be able to control anything going on in the real world. And I think until we get back to somewhat of a normalized economy, meaning one, we get out of the Middle East, two, we stop the deficit spending to the ridiculous amounts that we've been doing it the last few years. We make sure all the supply chains are back open. I mean, we still have some supply chain issues from 2020 that haven't been fully resolved. We still have some energy supply issues that haven't been fully resolved since 2020. It might be a few years before we get back there. Until we get back there, I honestly don't think that the Fed can fix all the things they want to fix, but they can make it worse. I think the Fed, Warsh is in a really tough position because he can't give Trump what Trump wants. He can't give the American people what we want without some second level impacts that we're not going to like, but he can mess things up. He can make things a whole lot worse. And so he's in a no-win situation.
Great summary.
How do you use all this information you have and knowledge about economics to influence your real estate decisions on what you're buying and when you're buying and how you're doing all that? Yeah.
So my attitude is fun fact about me is I used to play professional poker. And so I've done my share of gambling. And so I'm smart enough to know that when you walk into a casino, for the most part, you're not going to win. And so the house doesn't make money because they've got a massive advantage over us in the games we play. When I play blackjack, I may only be, if I play perfect blackjack by the book, I'm probably at a 1.5% disadvantage to the house. But the house makes billions, trillions of dollars over time. I lose all my money over time. So that 1% advantage that the house has over enough time is going to translate to them making a ton of money. And that 1% disadvantage is going to translate to me and other people going broke. Does that make sense?
Mm-hmm.
I look at economics the same way. I am never going to be able to tell you that we're going to have a recession 3 months from now or 6 months from now or 12 months from now. I'm never going to be able to tell you that interest rates are going up by 0.683% over the next X number of years. I'm not smart enough. Nobody's smart enough to know that. But if I can be directionally correct, if I can say, I think rates are more likely to go up than down, if I can say, I think housing values are more likely to stay flat versus going down, or if I think I can say whatever, and I can get a 1% edge over what I had yesterday, if I can get a 5% edge over everybody else out there because I have a little bit better knowledge, even though I'm not going to be right all the time. House doesn't win every hand. They don't have to win every hand. They just have to be right a little bit more than I am. If I can be right a little bit more than everybody else, if I can be right about the market a little bit more than random, 50-50 or whatever random is, I'm going to make money. And so my goal is to be right, directionally correct, to be right more than I would be if I wasn't paying attention. Because if I can get just that little bit of an edge over time, over enough time, that's going to translate into a much greater financial success.
Gotcha.
What direction are you going in right now?
There's no one direction. When you talk about the economy, you can't talk about one thing. And when you talk about investing, you can't talk about one thing. So we can have a discussion about how the economy is likely to impact single family flippers over the next couple years. That might be a different discussion than single family landlords, which might be a different discussion from multifamily, which might be a different discussion from commercial, which might be a different discussion from the stock market or gold or Bitcoin or owning racehorses or owning artwork. Every asset class is going to react differently to the same. You have the same economic conditions, but not every asset class is going to react the same. I mean, if you think about it, and this is one of the things I deal with in my business. I'm a multifamily guy. I own 1,400 units, and I have investors who, over the last few years, have seen multifamily struggle. To put things in perspective, after 2008, multifamily dropped somewhere between 20 and 25% in value. Since 2022, multifamilies dropped somewhere between 35 and 40% in value. Most people don't realize that because they look at real estate and they say, real estate's done well. My house has gone up. My investment properties have gone up. Maybe things are leveling off, but real estate's been great over the last couple of years. Well, the reality is in multifamily, it hasn't been. And so we have to realize that different asset classes are different. I can go to one location and things have been fantastic for the last couple of years. I can go to another location and values have dropped considerably. And so location plays a big difference. I can look at new construction versus buying stabilized versus buying value add properties, and everybody's going to have a different experience. And so if you ask where things are headed, we need to kind of narrow down what we're talking about. If we're
Let's
talking
talk
about
multifamily.
okay, well, so then we can narrow it down more. Are we talking new construction multifamily, buying distressed multifamily, buying stabilized multifamily? Are we talking in the Sun Belt? Are we talking about on the West Coast? Are we talking about the Southeast, the Northeast? So are we talking about A class versus B class?
Let's hear what
C class?
you're looking at and your takes on some of the stuff you're personally doing.
Yeah. So, and I didn't mean to get pedantic there.
Oh, yeah. No, you're good.
But it's really important that anything I say here, people realize that when you dig down into the
It's gospel.
details of the details, the things I say aren't necessarily going to hold true. So multifamily in general, at the highest level I mentioned, has dropped 35%, in some cases more, over the last few years. A lot of that's been because when you look at commercial real estate, multifamily, and other asset classes, there are two things that control values. It's your income, your NOI, and cap rates, this multiplier in the market. When you sell something, you get 15 or 20 or 25 times the income it's generating. And so if you want to know where commercial real estate is heading, the two things you have to ask are your incomes going up or down? And is that multiplier going up or down? And over the last couple of years, we've seen, number one, we've seen the income come down. Rents aren't going up very quickly because people are strapped for cash, but expenses are going up quickly. We have insurance hikes, we have property tax hikes, labor and material costs are going up, energy costs, utilities are going up. And so we're getting squeezed on both sides. We're making less income and we're spending more on expenses. So the net income is going down. And then on the other side, that multiplier is highly correlated to interest rates. Nobody's going to buy property at what's known as a 5% cap rate, basically a 20 multiplier, if they can buy bonds at 6%. Why would I buy a risky asset that I have to put a lot of work into at 5% if I can buy basically a risk-free asset at 6%? So as bond yields go up, as interest rates go up, that multiplier goes down. And so we've kind of gotten hit from both sides in the commercial real estate world the last couple of years. Income's down, multiplier down. And so the question is, where do we think those two things are going to head, the income and the multiplier, over the next couple of years? Incomes, we're finally starting to see that negative rent growth ease. We're starting to see in some markets positive rent growth again. Q4 of 25, we saw positive rent growth across the country. Q1 of 26, it kind of dipped negative a little bit, but I think we're on the cusp of seeing positive rent growth again over the next couple of years. So that's good. That's number one. Number two, we're starting to see an easing on expense growth. So insurance has grown at a lower rate over the last year than it has in any time in the last 5 years. So that's good. Property taxes aren't growing as much. We still have inflation, so labor and materials are still an issue. Energy costs are still an issue, but I think we're starting to see a slowdown on the expense side of the ledger. So if you look at incomes coming up a little bit faster, expenses growing a little bit slower, that's going to be good for the income side of the equation. Then there's this multiplier. And the multiplier, again, is going to be driven by interest rates. If interest rates start to come down, well, investors are going to be willing to accept a lower return on real estate because they're not getting these really high returns on bonds. And so the multiplier is going to go up. If we think interest rates are going to continue to go up, that's going to be bad for the multiplier. At the end of the day, what we're seeing is that income expenses just aren't changing that much, and the multiplier and interest rates aren't changing that much. And so I think multifamily real estate for the next couple of years, we're basically at a bottom, but I don't see us coming off of that bottom very quickly. So I do see some opportunities in multifamily, but across the nation, across locations, across exit strategies, across the A class, B class, C class, I think for the most part, the next couple of years are going to continue to be a struggle unless something major changes with income, expenses, or interest rates.
Dane, you had a take too of you thought we were going to be on the rise, correct? Or what?
I agree with him.
Okay.
In the sense that like I think now is the best time to build anything.
Yeah.
Because I don't see things dropping like crazy, and so if we're getting into fixed rate debt, we're in a good spot. And I mean, on construction, obviously construction to perm is always the best way to go, but I don't see interest rates raising drastically over the next few years. And so even if they stay the same and we're just underwriting to interest rates staying the same, if I'm breaking ground on a construction project right now, construction has been so hard over the last 3 years, to your point, because everything's dropped like crazy. Your underwriting has just gotten worse and worse and worse. And so you're underwriting based on, like, you're looking at the projects that broke ground in 2020, and then you're trying to make a project in 2023, 2024, 2025 work, and none of them worked. And so it's almost like, I don't want to call it gambling because it's not, but in a sense you have to say, okay, can I be directionally correct, which is what you're saying, and just say, okay, I don't know that it's going to get better, but based on what I'm looking at right now, it works, and I don't think it's going to get worse. And that's my whole bet, is that, okay, if I'm building right now and everybody else is unsure of whether it's going to get better or going to get worse, and all I can say is, okay, I don't think it's going to get worse. At least I can at least say that. And even if it gets a little bit worse, my project still works. Then I should for sure build right now because nobody else is doing it. And so then I'm just winning on the supply side. I'm winning because I know that demand is going to be increasing over time, that rents will increase over time. And so if I'm the only supply that's entering a market, I mean, if you're not somewhere where there's still, for some reason, builders built, like I don't know, there's parts of like Dallas where I'd be maybe a little confused, but there's parts of Dallas where I'd probably be still pretty excited about it. But then in the Northwest markets where everything is just slowed to a complete halt, I mean, you look at if you look at the like municipality reports for housing across Oregon, across Washington, every single one of them is like, hey, we're going to be 10,000 units short in the next 10 years, and we have nothing in the pipeline. And so it's like, I'm not arguing that like I'm super enthusiastic about where cap rates are on new construction right now. All I know is that we're going to need more housing. And if I can supply that when nobody else is, and then I'm the one delivering in 2 years or in 3 years, then I think I'll win. Like, it's not an I know, it's the directionally correct idea of just like, I can't see it getting a whole lot worse.
Yeah. Let me throw out a 3-point thesis on why I'm bullish on multifamily right now. Number one, everybody was excited about multifamily 5 years ago when prices were literally 35 or 40% higher. If you're going to get excited about multifamily at values 40% higher than they are today, how do you not get 10 times excited at values 40%?
This is when we make our money.
Now, it terrifies people. I remember in 2008, like, you get scared. People are terrified to buy because it's like, is this the end? But if you were excited at the top, you should be excited when we're at least close to the bottom. So that's point number one. Point number two is, unlike a single family flip, when you're buying value add or building multifamily, you're investing 2, 3, 5 years, maybe more. And so you can look at what's going on today and you can say, this is crap. I do not want to be investing today. But the reality is you're not going to be selling for 3 or 4 or 5 years. So the question is, are you going to want to own that thing in 3 or 4 or 5 years? Even if you're not happy today, if you're going to be happy that you bought it today in 5 years, go buy it. Just make sure, like you said, you can get that fixed rate long-term debt so that you don't have term or rate risk. Make sure that you can weather the storm, whatever gets thrown at you. But if you can, if you're going to be happy in 5 years, because in 5 years, the world's going to be a different place, hopefully much better from a multifamily perspective. If you're going to be happy in 5 years owning something, buy it today. And then the best reason, and you touched on this, to own or to build multifamily right now is in 2020, 2021, even 2022, interest rates were near zero. Every developer on the planet and their brother went out and started developing because when you get free money, you build.
You got to do something with it.
You do something with it.
Yeah.
And for the most part, a development project takes somewhere between 2 and 4 years. Like you're going to spend 2 years building it and stabilizing it, but then there's another year that you're going to spend 2 years building it. Then you're going to spend another year stabilizing it on the back end. You have probably had a year on the front end of doing your due diligence and entitling and permits and all of that stuff, getting your debt. So it's a 2, 3, 4 year project. So when all this building started in 2020, 21, 22, even into 2023, when does all of that finish? When does it all come out of the ground? Well, if you add 3 years to 2020, 2021, 2022, 2023, that meant 2023, 2024, 2025, and even 2026 is when you see a ridiculous amount of units being delivered. And what does all that supply do? It drives rents down. When you have thousands upon, I live in Southwest Florida. I live on the west coast of Florida, and we literally have had 5,000 units delivered in our small area over the last 4 years. That's driven vacancies up to 17%. We see 17% vacancy in Sarasota County right now. We've seen rents drop by 10% over the last couple years because so many units have been delivered. But guess what? What happened in 2023? Interest rates went up and everybody stopped building. And there was no building in 23. There was no building in 24. There was no building in 25. So now add 3 years from that. That means by the end of 2026, 2027, 2028, there's going to be 0 units delivered. So over the next couple of years, we're going to see this rebalancing. We're going to go from this massively oversupply to rebalancing and maybe even undersupply in markets that are seeing population growth. And that's when you're going to want to be delivering units. I want to start a project today so that in 2028 and 2029, I'm delivering units when nothing's been delivered for 2 or 3 years. Population has grown. There's demand, but there's no new housing. And so that's the reason why we're developing today, because we think delivering in 27, 28, and 29 is going to be like literally the best opportunity. And as developers start to realize that, they're going to start to realize it. They're going to start to build this year, next year, the following year. And by 30, 31, 32, the opportunity is going to be gone because everybody's going to be building to fill that demand. So the next few years are going to, I think, is going to be a nice little sweet spot for developers.
Can you talk a little bit about inflation? You mentioned got to get out of the Middle East and some of this. How much, even if the war ends today, what happens over the next 2 or 3 quarters that's affected by the last 60 days of being in Iran?
I am probably a lot more bearish than most people on this, but am I allowed to curse on this show?
Sure.
Yeah, we're fucked. So
how do you really feel, Jay?
I do not see how we avoid at this point a global recession based on just the last 60-day impact of the strait being closed. Essentially, like you said, if everything were to open up today, it's basically 2 weeks before ships get back through the strait and start filling up. and then it's another 6 weeks for them to start delivering that energy. And it's not just energy. Let's keep in mind, when we talk about crude oil, it's also liquefied natural gas, so LNG, which we don't use a ton of it here. We export a ton of it, but we don't use it. We don't realize that much of the planet relies on LNG over crude oil for things like manufacturing. And so that's as much of an impact as crude oil. Then there are things like sulfur, things like fertilizer, things like aluminum and iron core, all of these other things that are not getting delivered, but we don't talk about it because everybody's thinking about oil. But there are a lot of other things. All the fertilizer that doesn't get delivered means that any crops that need to go into the ground in the next 3 to 6 months are probably not going to yield nearly as much, and it's going to hit our food supply. And we're going to see, and you don't get to keep planting crops. It's not like houses where I can start building today, tomorrow, next month, 3 months after. With crops, you got a narrow time frame. And if we miss this year, basically we see food inflation for a year. Or things like helium. It's not just party balloons. I mean, helium runs things like data centers, and it's instrumental in creating silicon chips. And if we don't get helium back on track, basically we're going to lose 3 to 6 to 12 months of chip production. And we all know what's been bolstering the U.S. economy over the last 2 years. It's been AI. It's been data centers. And if we're not seeing chips being produced at the same rate, well, we're going to see data center CapEx spend drop considerably, and that's going to take our GDP negative. And so, long story short, I think we are already past the point of no return. I think this is an opinion, but I think a lot of very high-level officials and their buddies are doing their best to disguise the impact on oil by buying futures. I think that the oil market right now is being heavily manipulated to not look nearly as bad as it is. I mean, you see that because if you want to go buy oil futures, the contracts for oil, you're paying, depending on the type of oil, anywhere from $90 to $110 right now. But if you want to go buy a physical barrel of oil, you're spending $135, $140, $145 a barrel. How is it that the contract price for oil and the physical price for oil is so disconnected? It's because somebody's buying a lot of those contracts at prices much lower than what they should be. They're just, it's just not realistic. And so I suspect that there's a lot of manipulation going on to make it look like oil prices aren't going up and supply isn't as much of an issue as it currently is. You also have reserves. I mean, that's part of the reason why we haven't seen oil go up as quickly, is that we're releasing a lot of reserves, not just us, but countries around the world. And strategic reserves are at a low point. And it's going to take time to fill those back up. And so countries have two choices. They can either choose not to fill back up their strategic reserves, or they can do the right thing and refill them, because you never know what's going to come down the road and you're going to need it. And if they're taking supply out of like the inventory, the small amount of inventory that we're going to have over the next 6 to 12 months to fill up the reserves, that's going to reduce supply even more. But that's just the oil side. Then there's all the things that we need energy and helium and sulfur and aluminum to build. All of those things, China, India, Europe, they've stopped building those things for the most part. They've gone to 4-day work weeks, or they've gone to 3-day work weeks. And so all of those things, we haven't really seen supply constraints, because it takes 6 weeks for things to get manufactured, put on a ship, sent over here and sold. It's going to be another couple of weeks before we really start to see the impact of oil as an input, not just oil as its own product, really hitting inflation. So right now, if you look at inflation numbers, you see the headline number, the number that includes energy, shooting up. So CPI is 3.8% headlined, but core, which strips out energy, is still low. It's below 3%. Why is that still below 3%? Because we haven't seen the spillover of oil into all the things it makes going up in price. But we're going to start to see that over the next couple months. And again, I think I probably didn't state that well, but long story short, I think if this were to resolve today, 2027 is already a lost year. I think we already see a global recession that can't be stopped. And I think it's going to get ugly.
So how does a global recession, in your opinion, affect us as real estate investors and developers?
One thing I like to say is if the economy is doing well, there's no place I'd rather be than real estate. But even more so, if the economy is doing poorly, there's no place I'd rather be than real estate. And so at the end of the day, a global recession is not going to be good for real estate, but I think it's still going to be better for real estate than most other asset classes. You look over the last 160 years in this country, we've had 36 recessions. How many recessions have we seen a drop in single family residential values more than 1.5%?
Like 30 or like 2 of those 36s?
2. Exactly.
Yep.
2. 34 times out of 36 recessions, real estate hasn't taken a big hit. Can you say the same thing about the stock market? Can you say the same thing about other asset classes? No. Generally speaking, there's a correlation between the broader economic circumstances and investments. But real estate tends to be pretty consistent. What is the single biggest driver of real estate values over the last 160 years? If you draw 2 lines,
interest rates going down 1 point every decade for the past 3 decades.
I think it's the value of the dollar.
So if you want to draw 2 lines that basically look like they coincide, at least up until about 2014, real estate values and inflation.
Yeah.
Real estate tracks inflation. Real estate values have gone up about 3.1% on average over the last 120 years. Inflation's gone up about 3.2% over the last 120 years. And if you look at the 2 lines next to each other, you'll see that they basically move in sync. And so if you want to prognosticate on where real estate values are likely to go over the next 5, 10, 20 years, it's not so much looking at the broader economy, it's looking at inflation. Do we think we're going to see broad inflation over the next decade? If yes, real estate is the place to be. And right now I mentioned that 2014 is when those 2 lines started to diverge. Real estate values jumped way above the inflation trend line around 2014. It did in about 2005-06 as well, but then reconverged in 2012, and then they diverged again. I think the way that they will eventually converge again is real estate's going to stay flat for the next 5-6 years while inflation continues to pick up, and then those 2 lines are going to be right in sync again moving forward. And so if you think we're going to have inflation, own real estate.
I tend to, what you're describing, I have this thing inside my head where it's like, as an American, I'm worried, but as a real estate investor, I'm excited. Is that the right way to feel?
Depends on how many liquidity events you have coming up in the next 2 years. And like to wrap this up and keep on this train and keep it to real estate as well, I'd love to see your magic globe as far as fleet of liquidity. So I think the only thing that doesn't track with what you're saying or adds context to what you're saying about inflation and housing prices is that fleet of safety events that we've seen and how the decoupling from the real estate values getting ahead of inflation is that move to safety in the bond market, artificially lowering interest rates, which typically comes at a time when they slam interest rates to 0. And so the one thing that changes this is we haven't seen a fleet of safety be the bond market for 3+ years now. So a change of safety going back to the bond market is like the wild card, in my opinion.
Yeah. And so this is almost exactly the way I characterize it as well, Mike. A year ago, 2 years ago, let's say a year and a half ago, before the whole tariff thing became an issue, my thought was we were likely heading towards a recession. I think just from a timing perspective and a lot of other economic data pointed towards like at some point in the next couple of years, we're heading towards a recession. But most likely that recession was going to be manageable, relatively small, not a 2008 type event, not a 1929 type event, in which case, again, real estate tended to perform pretty well. And I would, if you would have asked me a year and a half, 2 years ago, I would have said 90% chance of a small recession, 10% chance of something bigger that actually leads into liquidity issues, fleet of safety, and interest rates going to 0. So 90% chance that everything was going to be fine. Now, between what's happened with tariffs over the last year, less of that right now, but what's going on in the Middle East right now, and supply chains and deficit spending, and some of the things we've seen with the bond market kind of quote unquote breaking, I changed those percentages. I'd now say we're probably 70-75% chance still of a recession that's not so bad that it impacts real estate tremendously, but a 25 or 30% chance that what we see is a massive recession that is another 2008 or 1929 event. And if that were to happen, basically all the good news that I've been talking about over the last half hour goes out the window. If we see a 2008 type event, if we see interest rates go to zero, if we see massive stimulus, if we see a huge spike in unemployment, if we see deflation from demand basically getting destroyed, if we see negative GDP for 2 years, stuff like that, I could see real estate taking a big hit along with every other asset class. Even though in that situation, I would rather own real estate than any other asset class. So I'm not necessarily saying it's going to be good, but no matter how good or bad it is, I would still rather own real estate because from a risk adjusted standpoint, real estate has historically been the single best investment on the planet.
Well stated.
There you have it. Buy real estate.
That was a power episode.
And hope it's not the 30%.
Yes.
Or just time it right.
Get long-term fixed rate debt.
Always get long-term fixed rate debt. 100%.
Yeah.
I mean, it's if there's no other advice that's given on this show, there it is.
Yeah. Amen.
Heed the advice.
Jay, if people want to follow you, I follow you on Facebook. It's Jason Scott. And then do you have other ways? You have probably a newsletter and some other things I'm not privy to. How do people find you?
Yeah, it's legally Jason, and Facebook will not let me just put J because it's not my legal name. They threaten to take away my blue check if I change it to a J.
The things we give up for our blue check.
Because it doesn't match my license. So yeah, Jason Scott on Facebook. And if you want to get on my newsletter, learn anything else about me and what I have going on, if you go to jscott.com, just the letter J, SCOTT.com, that'll link you out to everything.
Awesome. Jay, thanks. We're going to come back. You going to do another episode with us? Talk about deals?
Absolutely. Let's do it.
All right. All right. This is fun. Man, that was a great time. I could talk to you all day long. I think we're geeking out on this.
Yeah.
All right. Hey, Deal Junkies, that's Jay Scott. Follow him. Read his newsletter. It's important stuff. It's easy to understand, easy to digest, and it's very valuable information. We love you guys, and please share us with someone you love. If you want to reach out for a call, Trevor would love to talk to you. He wants to solve everybody's problems. Go to dealjunkiespodcast.com and book your free call today, and we'll see you next time.